Welcome to Markets Now. I'm Michelle, work with John Payne with Advanced Trading. So we had higher prices except for part of the wheat complex over in the grains and the livestock. Cattle were mostly lower hogs mix. So John, let's start off talking about corn and soybeans, some double-digit gains. Do you think it was all technical? Was it just short covering?
I would consider it short covering, although there are some bullish tailwinds in regards to news. We announced some sales this morning to, I believe, to Europe. Spain was a buyer, and then we also had some rumors of China buying corn. And the weather in Northeast Asia is not great right now. So the Chinese could certainly be having weather problems. I find it difficult to trade on Chinese weather news, but if that's what's going to rip the market higher, I think that's the case. I also saw some trading go on between Spain and Ukraine at, we'll call it $225 a metric ton. The U.S. is at $194 a metric ton. Now, with freight to Western Med, you're probably looking at $20 per metric ton. So the U.S. competes here. I don't think you need to see some sort of runaway market, get folks to, not hold their grain. I think there'll be buyers at those prices. The question is, does everybody want to sell at once here? And that's, the fear I kind of have in this July delivery is that you get guys throwing in the towel if the crop looks good, and then, the market can really cascade. But we have that, and then you have Brazil taxing their farmers another 20%, or give or take, from a new government bill that was pushed by the president yesterday. And that, these farmers are kind of at the cost of production. So if you're going to raise taxes in Brazil, you're going to slow down acreage growth, which honestly is probably the goal of the U.S. farmer at this point. If you look at this from a trade war perspective, the U.S. farmer would rather see the Brazilians not continue to grow like they do, and maybe this will help.
So John, when you get a short covering pop like this, how big a legs does it have?
I deal in probabilities and not certainties, and I would say, from an old crop perspective, not much. I think that the market really has to figure out a way to deal with the new supply coming online, combined with a pretty big carryover. I had a really good conversation this week with a guy who kind of pointed out, he's like, a year ago we were merging carryovers from kind of a broke situation, and then all of a sudden I got a paycheck. So the market kind of had to ration a little bit more early in the session, but now we have kind of 2 years building on itself. In the case of soybeans as well, where you're going to see this carryover growth, and how does that kind of merge in September time period? And that's really where I think the hedges need to go up front, and then assume that if the market doesn't break, those spreads will hold in, and maybe we have bottomed here. But I think we're more likely closer to a top than a bottom if you had to press me to it. That's just given what I'm watching.
So the rally in corn and soybeans got us back up into some chart resistance again. How difficult will it be to get above those areas now?
Well, there's still a gap on the D's at 503, and I'm sure every technical analyst knows that. For me, that would be the target if you're looking to sell. I think at this point, volatility's come down quite a bit, actually, relative to where it was just 4 weeks ago. Some of these options have cheapened up a little bit as the U.S. crop's in the ground. So, I think there's a chance to buy some upside protection. But if you're undersold, I don't think it's worth it. I think you've got to be willing to be early. Unfortunately, that price could be 470, 480. I'd like to think we get above that. I'm certainly rooting that we do, because I've worked with a lot of folks who have to sell supply, so I want to see them do well. But from a risk standpoint, you just saw the markets down to 390 in the March delivery. So I don't think you can shrug off a move up to 490 and just assume that it's going to stay there.
So the wheat market mostly lower on Thursday, and we've been down now about 7 days there as well. Even though we continue to get confirmation of this smaller crop in Russia, is that story priced in, do you think?
Yeah, I would think so. I think at this point, it certainly helps keep a low in. I think right now the U.S., it's kind of like, I don't know, I'm trying to probably oversimplifying this a little bit, but you have insurance period being set in the Kansas City wheat region. You have folks who don't want to sell in the Kansas City wheat region until they know what their crop looks like. And that is, as I was just kind of talking about in corn, like that's where the mystery price comes in. And if you're early and that crop doesn't come in, you pay for it. If you want to wait for certainty, you're probably going to get a cheaper price if it does come in. And Texas weather's been okay. It's it's been really wet. You know, the areas that, from what I've heard on wheat, that are really problematic are out east. But out west, for me, it's a crop that's average, which means they're going to grow, you know, 700 million bushels, which, you know, I don't know what the price is in, you know, in the Ukraine right now, or what it matters, what it is in Russia, when folks have to deliver to a, you know, a shuttle loader moving from Stillwater to the Gulf. It's when those things have to go, they're going to go. And I think the question is how much supply is going to come to the United States if, you know, these North African buyers don't want to chase Russian offers higher. And that's probably the most supportive thing out there.
Yeah. Cattle, another day where we were mostly lower. So are we getting caught up in these new bird flu stories you're getting, or is this part of a little bit of a healthy correction that we're doing?
Yeah, I mean, the boards in the livestock have been cheaper versus the supply, the cash markets for a while now. I mean, in the case of cattle, we're trading beef, we're trading 315 choice, 300 select. That's, you know, maybe not a runaway market anymore, but it's not cheap. So you have a hard time breaking the market on the board. But it is kind of weakening as you have these macro bets being placed, either being placed to the south side or just being taken off, where folks are throwing in the towel and saying, hey, maybe we won't rally anymore. Regardless, you know, I think economic activity, we've seen two pieces of news the last 2 days. One being that diesel usage in the United States is down at like 26-year lows. And then, you know, the second thing being that, you know, receipts for U.S. farms are off, and you're starting to see a recession, you know, being planned for in companies like John Deere. Those are just, you know, kind of indicators I think you have to pay attention to. But it doesn't mean the market has to go lower tomorrow. I certainly don't think that.
Yeah. And the hogs, new lows for the move today before we rebounded in the front end of the board. But essentially now that we've taken all the premium out, can we bottom this market, do you think?
I think the summer markets, you make the case. I mean, it's the time of the year for it. I would have said that for higher, you know, but at this point, you have a market that's just completely collapsed. The front of the curve, you know, is actually at almost a discount or a premium now almost at a discount to the cash, whereas, you know, we were trading at a premium, like a severe premium. And meanwhile, the cutout hasn't broken. Bellies are right where they've been, you know, between 120 and 135. And, you know, loins are up, ribs are more up year over year in the case of pork. So, you know, this is a packer boon. This is what they want to see. They've seen the board break. They can buy hogs cheaper. And, you know, but I think the real supply side news will come in 3 weeks when we get the quarterly numbers and just see what the herd is going to look like. I think in the short run, hogs are there. But, you know, have we seen the sows liquidated to the point where you're starting to see the back of the curve? Maybe supply will be a problem. I don't know. I don't think we're probably there yet, but it's a bet I might be willing to make on certainly on a couple dollar rally in the February.
And the $16, $18 break we've had from the contract highs, how much has that squeezed margins?
A lot. I mean, just on the feeding margins. And I mean, of course, it's different for every farmer. You're not always buying your feed at the same time, but just we track an input with feeder cattle, and we track an input with, I'm sorry, not feeder cattle, soybean meal, and we track an input with corn, 3 corn, 1 meal, and then we take 8 hogs. That's my math on it. $205 weight or 205 pound weight hog dressed, and you look at a per head margin that was like 160, and that's not profit margin, that's just like gross total premium in the contract, $163 per head feeding margin, and now it's down to like 120. So and that's a little better than it was in DESA 23, but it's pretty ugly. And you know, I mean, I just say that's where, you know, in the case of wheat, I had a producer talk yesterday, and it's like, you just can't assume these markets are going to give it and not give it back. Like when you get a rally, you have to have supply to sell if you need to get rid of it in the short run. Otherwise, you're going to sell it when everybody has it. And, you know, when it's certain it's going to be cheaper. And that's, I think, the market we're in right now for the foreseeable future, at least until we start to see supply slow globally and you know, economic activity pick up globally, because that's really where the problem is. And so it's a difficult situation right now to kind of be bullish these markets, but that's why we're down 15. All
right. Thanks for your time as always. John Payne with Advanced Trading. Remember, futures and options do have substantial risk, and this is Markets Now.